I often say to people who come to San Francisco to raise money that this is the most competitive professional environment you're likely to encounter in your life. And that you're going to need to do 100 meetings to raise $1 million.
Peter Saddington, your big game hunter. And guys, we have our sights on someone special today. Only a mother could invest in this idea.
Made this like super artistic.
That is actually absolutely correct. And that's a very, very astute assessment, actually.
Welcome, everybody, to another episode of VC Hunting with me, Peter Saddington, your big game hunter. And guys, we have our sights on someone special today. He is an entrepreneur turned investor, and he at Sterling Road, and he focuses on pre-seed stage B2B companies. Ash Rust. Hey, Ash, thanks so much for being on the show.
Thank you for having me. I appreciate it.
Well, Ash, let's just jump right in here. I want to understand how you got into venture capital. So give us some context. What was the situation? What was the circumstance in which you were that led up to making the decision or the full jump into venture capital and invariably starting your first fund? Give us some of that context and what those decisions were like.
Yeah, so I have been in Silicon Valley for about 12 years. And so I'd been at a few companies as an engineer and then as a founder. And so when we sold my last company in 2015, I found myself thinking about new ideas as well as helping other entrepreneurs. And I was getting more and more inbound from entrepreneurs asking me for help on how to manage an acquisition or how to raise money or hire people, those kinds of things. And so I found myself more drawn to doing that and helping the founders in the very early stages versus building another company. And so, yeah, from there, I wanted to spend time at venture capitalists because I thought, well, if these people are the people that are doing that job, so I should go and hang out with them. And unfortunately discovered I hated doing their job. It's actually a lot rougher than you would imagine. Yeah, true story. Being a VC is actually quite tough, I think. If you work at a farm with 6 partners and $400 or $500 million under management, it's an incredibly tough job. And I didn't really want to do it that way. So I ended up, and the people where I was working at a VC fund at the time, and they were very nice about it. They said, you should stop working here and we'll give you some money to raise your own fund, which was awesome. Yeah, exactly. It's basically
they had to have some significant trust in your abilities to execute. I mean, would you say? I mean, so
right, yeah. Or wanted me out of the office really badly. Yeah, one of those two. I'm gonna go with your idea though. So from there, that gave me the momentum to raise a fund of my own, just a very small one. So the first fund I raised was a $3 million fund in 2017. And that was just really focused on helping people at that very early stage, which was the original thing that I wanted to do. So that's how it happened.
Well, and so I love this idea that people, as you had your company acquired in 2015, people began to, as you were kind of maybe trying to figure out and discover yourself again and figure out what you wanted to do again, you said that people reached out and said, hey, you've done this before. So they're asking you for help. And so was the incentive to actually help people and operate and help them build it? Or was there an idea of, hey, people are reaching out to me, there's money in this? And so is that the reason why you moved into
right?
Right, because you can service early stage companies, you can help early stage companies without necessarily going into venture capital. So help us understand, where did that transition happen?
Well, I think that the reason why I wanted to be an investor in these companies rather than necessarily be a vendor to the companies and charge them hour by hour is two things. First of all, in the earliest days, you don't really want to be taking any money out of a company. At least that's my feeling. Not everybody would share that philosophy, but you usually want to put every dollar you can into building the company and growing that business rather than giving it to someone else who's maybe a third-party vendor. So that's a good reason why, for example, lawyers do deferred fees a lot of the time for early stage companies, because they don't, they're going to kill the company if they charge them that money right now. So that was the first thing. And then the second thing is, just if you want access to the very best people, you want to work with the very, very best people, oftentimes they can get access to that kind of advice for free. Because there's other people that would want to help them because it's really special working with them.
Right.
Great people are fun to work with. And so I didn't want to charge for it up front because that meant that I got to work with the best possible people I could choose. It wouldn't just be people who could afford to pay me, for example.
Right.
But obviously you've got to eat. And so having some mechanism of getting ownership in the business is a way to sort of offset that and make it a long-term decision where your interests are aligned with the founders as well.
You know, it's really interesting that I have seen a pattern, and you can validate this with me, but I think it's similar with you here, is that the pattern is that individuals who start their first fund, it really stems from other people saying, hey, look, I need help. You've done this before, you have experience in this, and creating a fund tends to be like a great catch-all for, hey, I want to help people out. I want to help them level up. I want to help them help their startup. I want to help guide them through some of the pitfalls that I went through, some of the mistakes that I went through. And so it seems like that tends to be a pattern. I mean, would you say that's the same with you here? Is that
that's certainly, that's what I wanted to do. Yeah, I really enjoyed helping people in those very earliest stages up to maybe their first $1 million in revenue. That's where I'm a specialist. And so turning that into a job was my dream job. That's how I pitch it to my investors. I tell them that this is my dream job and I discovered it by accident. But now I'm going to do it for the next 50 years. And it's kind of a nice side effect that it's a venture capital and it happens to be lucrative.
Yeah, and it gives you the opportunity to constantly learn from all these different investments that you're making. Now you focus on, obviously there's a little bit of a constraint there, pre-seed, right, B2B. But I have a quote that I want to see if it's still true. On October 24th, so we do a little bit of digging here, Ash. On October 24th, 2017, on Twitter, you tweeted, quote, watching a founder handle the highs and lows of fundraising is one of the best ways to see who they really are. Is that something that you still believe in? Is that something that still shines true and it excites you about your investments today?
Yeah, I think it's even truer now. I'd say I look at those kinds of data points of how people respond when there's a lot of money at stake as a good reflection of how they're going to respond in other pressurized situations over the next 10 years that we might be working together. And so getting to see founders go through a fundraising process is a huge advantage as far as I'm concerned. I think that it's quite easy for someone who's good at presenting themselves to act for 1 or 2 hours. I think it's very hard to do that over a 90-day period when maybe you're going through a fundraising process. And you're going to show the reality of what you're experiencing during that time. And so that visibility is very valuable for me as an investor. I think on the other side of that, I want to try and be valuable during that time. So I'm not just, a fly on the wall watching and be like, oh, this is rough. I want to try and help you through that.
Man, that sucks, bro.
Yeah, exactly. High fives later. So my goal is to try and be valuable during that time period, to give you the tactics that are going to make your life as easy as possible and try and make you successful. I often say to people who come to San Francisco to raise money at the seed or pre-seed stage, that this is the most competitive professional environment you're likely to encounter in your life. And that you're going to need to do 100 meetings to raise $1 million in most cases. And that's an awful lot of work. And oftentimes people won't climb that mountain unless they can be shown how the first 2 or 3 steps work. And so that's where I come in.
And I love that you're able to really communicate not only your passion, but what you're good at, helping people get to that 1 million, helping, pre-seed, early stage hustlers, grinders. And so I have to ask you this question, because whenever I talk to venture capitalists who are into the pre-seed or the even before they really have a good idea of what they want to do, it's kind of sadomasochistic. I mean, let's be honest. There's a lot of suffering in the early grind and you just talked about the first 90 days of seeing the highs and lows of depression hit, of trying to get through and persevere through some of the worst times in the early stage. What is it about pre-seed and early grinding startups that is exciting to you? Because these are the hardest times of a startup. You know this.
Yeah, I think it's also the most exciting times. I think this is when you get to focus the most on your passion, when you get to spend most time, at least the founders get to spend the most time working with customers and really trying to satisfy them. As your business grows into a 7-figure plus business with 20 plus people, you know, real revenue targets,
Things get
real
boring
expectations from customers. Well, your ability to move things changes a lot, right? So it's exciting, but in very different ways. So your excitement comes from things like, you know, landing that executive that you wanted to hire, or resolving that HR issue that's been bothering people for months. Those kinds of things, although it may well not be as exciting for a TechCrunch article, but it certainly feels exciting at the time. But I think that for me, what I'm interested in is when people, you know, first make it to getting their customers happy, when they first get their revenue, so those first checks, those first customers, those first fundraising investments. Those kinds of things are the area where for some reason, I like that more. Based on, I mean, I tried it. I did work at other VC firms where they were doing later stage stuff, but yeah, not for me. I also don't think it's sadomasochistic, because it's only if you have a high failure rate. I think that one of the big things about pre-seed and seed is that people write lots of checks, and that's really not my philosophy. I'll probably only do 7 or 8 investments this year, whereas a lot of pre-seed investors might do 20 to 50.
Now let's pause on that. Why? What makes your thesis, or how have you formulated your thesis that is different from often the, hey, 25 grand a pop, boom, 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 right? So what makes your thesis different here?
Yeah, so I'm going to spend a lot more time with you after the check. So because I'm spending all this time with you before we write the first investment, I'm also going to continue spending that time with you every 2 weeks going forward for sometimes 18 months to 2 years. And so I try to compare myself to when you go to the bowling alley with your kids and you put the bumpers up so nobody has a bad day, right? It doesn't mean that they're going to score more than 100, but it kind of stops failure. And that's what I am. I'm a good mechanism to stop failure. So, you know, sometimes
founders have a bad day with Ash Russ, guys.
Well, I would say that you'll hear it from me first before it becomes a bad day, you know, for a longer period of time. Yeah, exactly. So having seen plenty of those kinds of really tough dramas, I can help you avoid them. So for example, a founder in my portfolio once called me right after raising a round of a few $1 million and was like, we're going to acquire a company. It's going to be $1 million. We can totally afford it right now. You know, and for a seed stage company, buying another company at that point is usually not a great idea. Being able to convince them otherwise averts disaster. And so I have a much lower failure rate. I have about 20 investments in my portfolio, and only 10% have ever failed.
You got me intrigued because my little antenna went up. How did you convince a pre-seed investment of yours to not spend $1 million on acquiring another company? I mean, notwithstanding the whole, like, you as a pre-seed or a seed, you don't even have your own culture formulated. Nevertheless, trying to acquire and ingest a whole new culture and the dysfunctional, you know, relationships in there. I mean, how did you walk them off the cliff there?
Well, first of all, we have regular meetings scheduled. So it's not that, the nice thing is that it's not like it's going to be a surprise, as in they've already done it or they're already moving forward with that. I'm going to usually find out about these things when they're at the idea phase. So catching things early is a big factor. Then I try and explain what I think are the pros and cons of doing these kinds of things. And I try and give examples of which companies might be analogous and successful, and how oftentimes focus is the message I'm trying to give in those kinds of situations. If you're trying to acquire a company, often you might be doing it because you want their customers or because you want their product. And if it's because you want their product, that might be a new product versus what you have. Doing that at the seed stage often means having
something's got to give.
High focus. Yeah, exactly. So you're going to only do a B+ job on 2 things versus being able to do an A+ job on 1 thing. And so that message delivered over time in an understanding manner, with a little bit of, you know, the English accent, a bit of firmness, I guess, over time. That's how I try and do it. But ultimately, you know, I try and explain to the CEOs that I work for them. So it's my job in that situation when they pose a question to me to go and find the answer for them. So I'll give them my initial reaction. But if that went further and they were pursuing it more aggressively, maybe I'd try and find other founders who had done this successfully or unsuccessfully, and maybe try and introduce them the people in my portfolio and see if that influences their decision as well.
You know, I find it fascinating and at the same time interesting that when it comes to individuals who start funds and start funds for helping people, so much of what you do, and I was talking to another VC about this similarly, so much of what you do is like counseling. I mean, wouldn't you say, isn't that part and parcel of pre-seed, early stage companies, especially if you're as an investor, it's counseling through the process of venture capital, counseling them through the process of building a startup. And this example that you just gave, it rang to me of like, wow, I could totally see Ash sitting there like, this is what we need to talk about. These are the problems. It's very much like a
Right.
counselor. I mean, wouldn't you say that in a lot of ways you have to counsel, and part of that, well, obviously counsel, but counsel more than just the product. You have to counsel the person, would you say?
Yeah, but I try and steer away from the emotional aspect of this and much more focus on the tactical thing. But I do think that you are counsel in the sense of you're trying to provide strategic advice. So what should we focus? A good example came yesterday. One of my portfolio companies is thinking about whether or not they should be doing fundraising as well as satisfying their existing customers. They made some promises to existing customers,
Right.
but they've also got a lot of investor interest right now. And so making that decision, that was counseling them through that, but it was more, there wasn't an emotional aspect to it. So, there's no yoga, no joss sticks going on or incense in these kinds of situations. But we are talking about, what's going to happen, how that's going to feel, what's expected of you. And, and certainly that involves, saying things like, yeah, this is probably going to be an all-nighter for you to solve this, or you need to make sure these 8 things are done by Thursday. Those kinds of times are sometimes tough.
For sure. And give me an example. What's a piece of advice that you've given one of your investments recently? And how was it received? How was it received by the individual?
Okay, so one of the most common things that I said, and something I said probably last week, is you need to charge more. So a lot of founders don't like charging a lot of money for their products because maybe their market has a lot of people who charge a small amount of money for a similar service. Or
tell me more. Why?
Well, so the thing is that if you're an early stage company, you're in a much better position to provide a premium concierge service than you are to provide a great self-serve service. Think about it, just like a company like Facebook or Google has thousands of engineers all trying to make every single screen that you see smooth as butter, right? Because 1 or 2% here or there matters a lot. Whereas you have, you and your 2 friends in your bedroom building this company, or in your living room if you've got kids.
Or the garage.
The garage, yeah, exactly. Yeah, so you're building it with your family members or with your friends, and when you're in that position, you have a lot less engineering resources, but you can pick up the phone. You can make one customer really, really happy, and getting to 1 or 2 customers is the only hurdle that you have at that very earliest stage. When you're at 0 customers, the only job is getting to 1 customer. Yes. So it's much easier to do that if you're trying to provide a concierge service, so you can just be, a butler for them, literally, versus trying to provide great software.
And I think that really plays to your strengths too, which is relational. I mean, your first customers really, they're really more oftentimes relational or relational based on experience, and saying, hey, I've known you for a long time. I've started this startup. Please help me. It's building something within your space. And so I think that makes a lot of sense. Speaking of relationships, relationships and the value of relationships and pitching, here's another thing that I dug up about you on October 25th. October 25th.
I got to delete my tweets.
2017. So we're going back a little bit here. You said, quote, don't say your competition is old and dumb in pitches. Say how you're different and why it's sustainable for a decade. Is this still the best answer what's the best answer that you've heard?
Yeah. I mean, that is the thing that's most common now actually is, we don't have any competition, which is also a hilarious thing to say. And again, it doesn't help you, unfortunately, from the founder's perspective. I do think that's true. Oftentimes, founders want to think about their products as a beautiful and unique snowflake. And while I'm sure that's true, your potential customers don't see it that way. They see you as one of a list of vendors who can potentially solve a problem for them.
So how do you differentiate? What would your advice to be?
So, I think that you should talk to your customers. First of all, if you have an idea of the best companies usually come from people who have some domain expertise. So ideally, you go back and talk to people who are from the industry that you're familiar with, and you ask them about the problems that they're facing, and you try and see if it's reasonable for you to solve them. And if you do so, can you generate enough revenue for you to be sustainable by itself? So, for example, let's take an older business, something like Twilio. It wasn't easy for people back in 2010 to send text messages from their iPhone apps to people to verify stuff. Twilio made that easy. There were lots of other ways you could do it, but it wasn't $20 to get started, 3 lines of code that was already pre-written for you, and you could just throw that in there. So that's a good example of how they differentiated. Now, what's interesting about Twilio is they still made all their money from the big players. A big chunk of their money comes from WhatsApp. It comes from Uber, those kinds of people. So even though they started off by grabbing people who were very small and niche via the developer community, and that's what their billboards still say. They have billboards in San Francisco that say, ask your developer. So it's still pitching that same thing, but ultimately what they're banking on is some of those small companies and developers are going to grow up into big fish, because that's where the majority of the revenue is coming from.
Awesome. Well, I want to pivot with another question here, because we obviously, Ash, $3 million, your first fund. There's a lot of lessons that are kind of in there, I'm sure. And so I want to ask a lot of lessons. Here's my first question. I only have 2. Well, maybe we can bring you on for the next season if you're willing, and ask you more questions. But the first question I have about your first fund is really broad. How did it go? How would you rate yourself if it's even possible? I know it's going to require you to think for a second, but in a let's say a 1 to 10, how would you rate yourself? How has your first fund gone? Has it lived up to the expectations or the perceptions that you had, or have those fundamentally changed and been destroyed by the realities of the suck?
Yeah, so the realities of venture capital are that unless you get into the top sort of 10 to 20% of performers across your peer group, then you won't get to raise a second fund. And I'm very lucky to be deploying out of my second fund at present. So I'd like to think that's a fair reflection. And I'd rather grade myself on what my investors who, came from fund 1 into fund 2 think, rather than my personal feeling, which is obviously 12 out of 10. So I think the thing I'm most proud of with the fund, though, is that out of 12 investments, only 2 have failed. So venture capital spends a lot of time talking and writing about home runs, when the reality of the mathematics can sometimes work out differently if you have lots of companies that don't fail and come back but generating real value. And so what I'm really proud of is that we have lots of companies that have 7-figure revenue. We have lots, and we have very few companies that have failed.
Wow.
And so maybe that's not what's going to get, again, a Forbes article, but it is something that is, I'm very proud of, because it means that you're not treating people like lottery tickets. It means that we've invested a bunch of time together. You've built something sustainable. And even if that doesn't work out to be Uber, there's a really good chance that we'll all make money.
Well, yeah, and obviously, I think that's the very great way to end it. Yeah, we'll all make money, but I think for you, and I think maybe I'm putting words in your mouth. You get to enjoy those highs even higher because it's only 12 or it's only 10. It's not 100 that you've invested in this year, right? And on the other side of that coin is the lows are even lower. The 2 out of 12 that did fail, I'm sure were heartbreaking to you because you spent time, and money. And
I have to spend a lot more time with them as well. So because we have that long-standing relationship, it's not just the experience of it. It's also just the days and hours. Sure. I have to invest a lot more time in the failures that I work with because they would expect that given the existing relationships.
For sure. And I'm sure my second question, because I already knew that your fund is successful. I know. Here's my second question. What do you think? Now, this is obviously highly relative and contextual to you, but what would you say would be one of the reasons why you've had success with your first fund? Because if we rate a first fund against the chances of any other startup in its in its incubation stage, the chances of any startup actually succeeding is like less than 1%. So likewise, we can assume creating your first fund, even with the relational equity you may have and people who trust you with their money, the chances aren't that good. So, I mean, having your first fund and it being successful, what would you say for you is a personal anecdote as to why?
So the market tries to pull you a lot in very different directions, especially in a place that a land of opportunity like San Francisco. There's always a company that you can invest in today that's closing their round on Friday, and all the cool people are investing in that company.
For sure.
You should totally come along for the ride. And I don't take those meetings, and I never have. My plan never is to never do that. And I think doing that has saved me a lot of time and has allowed me the freedom to spend way more time with the people that have invested time with me. And I think that has been the biggest differentiator.
Awesome. I love this. I'm writing it down. I said that, Ash Russ, you enjoy spending time with people and enjoy doing that diligence and grinding with them than over a big number in your portfolio. Is that a fair statement?
I think so, yeah.
Awesome. Well, let's round this out with one last question for you, Ash. And again, I thank you for being on today. On November 24th, we're going all the way back to 2015, Ash. You tweeted at one of your friends, I suppose, Josh Ellman. You said, "What about that Warhammer game, though? Do you like Warhammer?"
I used to play Warhammer a long time ago. Gosh, I think I came third in a Blood Bowl tournament, which is like one of the Warhammer games.
Wow,
I was like 12, awesome. Yeah, back in the UK.
What's a Blood Bowl? What's a Blood Bowl?
So Blood Bowl is like American football set in the Lord of the Rings kind of universe.
Okay.
I was playing it when I was like 11 or 12, like a good nerd in training. And so they had some kind of national competition back in the UK. Maybe 4 or 5 people turned up. I probably came in the middle of the pack. Yeah. That's my story.
Well, thank you again so much, Ash Russ from Sterling Road, for joining us on today's episode of VC Hunting. Thanks again, brother.
Thank you. Thanks for having me.
Wow. Well, that was a great conversation. I hope you guys enjoyed that just as much as I did with Ash Russ from Sterling Road. It seems like, at least at the end of our conversation, seems like he was hinting, and I didn't want to go, maybe I should have asked him about it, but he seemed like he was hinting on this second fund. And so he is a successful first fund of $3 million, doing really well. Out of all the investments, 12 investments, only 2 have failed. Man, he certainly must have something going on. So certainly, obviously, as a venture capitalist, I gotta shill him in a good way, guys. So make your way over to vchunting.com/ashrust, and you can find more information about him and his fund and what's going on. Maybe if you have a great idea, maybe you're one of those pre-seed stage B2B ideas, he might be just the guy to talk to. I really enjoyed some of the things that we talked about, though. I love the fact that he began in product development, began in product engineering and development, and then after selling his first company in 2015, people started going to him. Now I find this to be a common theme, a common pattern, that after successful people, it makes sense now as I'm saying it, obviously, it'd be like Captain Obvious, but after people have some success in their lives, then people who are assertive, people who have a little bit of a wherewithal, will ask them and say, "Hey, what did you do differently? What made you successful?" And what's great about someone like Ash Russ is that he's the type of person that would take that help or take those opportunities and say, "Yeah, man, you need help? Totally willing to help you. Here's what you need to do. Let me help you through the grind. Let me help you through some of the beginnings." Right, and then invariably helped him move into the venture capital world. You know, it's really cool that guys like Ash Russ exist, because they are the type of guys who really love, not for the numbers' sake, but they love the relationship aspect of venture capital. They love the relationship aspect of building startups and building products and services. You know, he's only, a lot of these micro VCs, a lot of these, small fund VCs, they shotgun. They spend money wherever they can. If there's a great idea, they're allowed to have that type of risk, right? Ash's thesis is a little bit different. And I think this is great that we can have different perspectives and different people on this show that have different theses of how they run their funds. And so for Ash, it's all about the relationship. It's all about getting in there with the, as he said, not sadomasochistic. He enjoys the process. He enjoys the process, helping them out, getting to their first million, as he said, and helping them be successful. It's great to have so many opportunities out there, guys. There's so many different VCs to talk to, so many different people that are giving of their success, right? Ash Rust was successful. Now he's giving it back to the world, and now he can spread his success to even more people. That just makes me feel good. And he's a great guy, which I probably should have said it, and I'm just getting the kinks out. Ash Rust has invested in my companies. That should have been in the beginning. But guys, I hope you enjoyed my conversation with Ash Rust. He's a wonderful guy. Check him out. And if you want more information, find your way over to vchunting.com/Ash Rust. Thanks guys for being here on this episode of VC Hunting with me, your big game hunter, Peter Saddington. See you guys next time.